9 out of 10 retail investors in Indian F&O market lost money between 2022 and 2024. Every bet brings in brokerage, taxes and spreads. Forward becomes future only when standardization and regulation entered, like paying rupees 100 to keep a window seat on a flight you might take. SEBI is acting like school principal finally entering into a classroom which is full of flying chalk pieces. If you are a college graduate with 50,000 in savings and a dream of passive income, this is not your playground. Hello and welcome back to Money Sutra, where your investment is just not numbers, but full of drama, dreams, and sometimes disasters. I'm Malhar, and today we go deep into the thrilling, chilling world of derivatives. Now, I have written in the Telegraph recently the 1.8 trillion wipeout. The numbers were shocking. 9 out of 10 retail investors in Indian F&O market lost money between 2022 and 2024, not in lakhs, but in crores, lakhs of crores, 1.8 lakh crore. You may think I know derivatives, futures, options, swaps. I've seen YouTube videos. Boss, let me tell you a secret. Most people only understand one thing about derivatives. I can get rich quickly. And that's the biggest myth we are busting today. So pour yourself a cup of tea or filter coffee if you prefer. This is a long ride, but a ride you won't forget. So I heard something in a tea stall in Tollygunj. Two young men are chatting over ghugni and muri, a favorite breakfast. Bhai, I took 2 lots of Nifty futures. Expiry this Thursday. I am telling you, market will bounce. Only 30,000 margin. Lot size 50. Profit potential 10,000 er opor. Sounds familiar. Welcome to the India's hottest fantasy league, the F&O, the futures and option. And let's decode futures first. So imagine you run a mustard oil factory, teler factory, and you expect prices of mustard to rise in 2 months. But you want to lock in today's rate. So you enter into a futures contract, a standardized agreement on the exchange to buy mustard seeds at a fixed price 2 months later. Why? Because you want certainty. You are not speculating, you're protecting your cost. But our tea stall friends or traders isn't hedging anything. He's just betting, hoping the prices goes up. That's not futures trading. That's pure speculation. And the exchange loves it because every bet brings in brokerage, taxes and spreads. So now let's rewind. Before futures, there were forwards. So in Bada Bazaar, traders still do it. I will give you, one trader is saying to the other, I'll give you 100 sacks of rice after 2 weeks at rupees 2,500 per quintal. Handshake, no exchange, just trust. That's a forward. Private, flexible, risky. If the market crashes or the seller runs away, tough luck. Forward becomes future only when standardization and regulation entered. Think of it as moving from a pawn shop bookkeeping to Google Sheets. But the story here is forwards are relationship contracts. They are there for ages. Futures are public betting parlors. Now let me talk about Ramesh. He works in a small office in Sector 5 in Salt Lake. His friends told him about call options. So Ramesh spends 2,000 rupees buying a call option. That is a right to buy HDFC Bank at 1500 next Thursday. Market moves, HDFC Bank touches 1530. Ramesh was really excited, but there is something called time decay, what traders call theta, which eats into his premium. So by Thursday, the expiry day, the price is 1510, but his option, which he bought at 2000 rupees, is now worth only 500 rupees. Why? Because options are not about where the price goes. They are about how quickly it gets there and how much volatility it sees on the way. Think of options like paying rupees 100 to keep a window seat on a flight you might take. If you don't take the flight, you lose the money. If you fly and the seat was worth it, great. But if the seat next to you is empty anyway, was it worth paying extra? Retail traders are playing options like lottery tickets. Now comes the more mysterious one, swaps. Let me introduce you to Anuja, a CFO of a mid-size exporter in Surat. Her company has taken a loan at a floating rate. Interest rate goes up and down, we know all that. But Anuja wants predictability. So she meets a bank. The bank says, let's swap. You pay us fixed interest, we pay you floating interest to the lender. Both sides win. This is basic interest rate swap. But it doesn't end there. The classic by Satyajit Das, Traders, Guns and Money, he referred to an Indonesian noodle company who took swaps and advised by global bankers. They were told that it would reduce their cost of operation. So in 1997, when rupiah collapsed, that Indonesian rupiah collapsed, the swaps magnified their debt. Their 300 million loan turned into a 600 million time bomb. That's why Warren Buffett called derivatives weapons of mass destruction. Swaps are more like arranged marriages with hidden prenups. Great if you've understood them, dangerous if you don't. Between 2022 and 24, 1.13 crore Indians traded in FNO, and SEBI says 93% of them lost money. The average loss? Rupees 2 lakh. That is, for every trader, lost 2 lakh on an average. And 50,000 crore went into just transaction cost. That's a trade mill that charge you money just to walk and go nowhere. And it gets worse. 43% of these traders, that is 43% of the people who lost money of that 1.13 crores, are under 30 years of age. Most earn under 5 lakh a year, and 72% of them are from tier 2 and tier 3 cities. They're the smaller cities. So before they even start a SIP, they lost 2 lakh rupees a year. This is not strategy. This is social gambling. There is a fantastic note which says that retail traders made 99 types of errors. No one talks about this. Emotional errors, there are technical errors, there are timing errors, but robots did not. SEBI found that proprietary firms, that is proprietary trading firms and foreign institutional investors made 61,000 crores in profit, while normal people, retailers, lose 1.8 lakh crores. And 96% of that profit of the foreign institutional investor came from algorithmic trading. So what is really happening is you are playing blindfolded chess against supercomputers trained by Ivy League ones. The result is predictable. SEBI has now stepped in with 7 big reforms. Number 1, reducing strike price to avoid confusion. Number 2, mandatory upfront premium payment. Number 3, no expiry day margin benefit. Number 4, monitoring intraday possession in real time. Number 5, raising lot sizes. Number 6, fewer expiry contracts. And number 7, promoting investor education. That's the biggest thing which has to be done. It's, SEBI is acting like school principal finally entering into a classroom which is full of flying chalk pieces. But reforms can't protect you from ignorance. Only understanding can. Who should use derivatives really? Ask any seasoned investor, late Rakesh Jhunjhunwala, beat Nilesh Shah, beat Ramdev Agarwal, and they will exactly tell you what I am telling you. Derivatives are meant for hedging, not hunting. So if you are an HNI, high net worth investor with large equity portfolio, you may use options to hedge against certain drops. If you are a business managing currency exposure, swaps make sense. But if you are a college graduate with 50,000 in savings and a dream of passive income, this is not your playground. Derivatives magnify risk. They are like Formula 1 car, thrilling for trained driver, fatal for novices. So be the farmer, not the gambler. Think of derivatives like a sickle. A farmer uses a sickle to harvest. A fool tries to juggle with that. Derivatives are brilliant when they use for risk management. They are deadly when used to chase thrills. So don't be the noodle company that got seduced by smart suits and complex terms. Be the exporter who locks currency risk. Be the investor who hedges his portfolio. use derivatives the way a surgeon uses a scalpel, not the way a magician waves a wand. So, in money, as in life, slow and steady not only wins the race, they survive it. So, if today's episode gave you something to think about, share it with someone in your circle who says, Boss, this expiry, I'll make it back. And if you want to go deeper, read my article in the Telegraph titled The 1.8 Trillion Wipeout. It's a reality check. Subscribe to Money Sutra, where we narrate not just what money does, but what it is meant for. Till next time, stay wise and stay curious.